China is reportedly considering a rescue package backed by offshore money, which is income or assets that is located outside of one's home country, usually in a low tax or relaxed regulation jurisdiction. Offshore money can be used for various purposes, such as tax avoidance, asset protection, or international business transactions. This is considered by China to stave off a slump in its struggling stock markets. The report, citing people familiar with the matter, said Chinese authorities are aiming to get about 2 trillion yuan, which is about $278 billion, primarily through offshore accounts of Chinese state-owned companies, as part of a stabilization fund to buy shares onshore through the Hong Kong exchange link. This is a significant amount of money, equivalent to about 2% of China's GDP or 10% of its foreign exchange reserves. China's stock markets has had an inferior start to the year, with irregular economic growth and a renewed crash in home sales last week, solidifying many foreign investors' resolve to steer clear of the country's markets. Global money managers have sold roughly $1.6 billion in Chinese equities collectively so far this year, driven mainly by European active funds and Hong Kong passive money. Chinese investors are also borrowing stocks, preferring to park their money in safer assets like bonds or cash. The main reasons for the bearish approach is because China's economy appears to slow down, as the impact of the COVID-19 pandemic, the trade war with the US, and the regulatory crackdown on various sectors weigh on growth. China's GDP grew by around 5.2% in 2023, the lowest in 3 decades, and is expected to slow further. The slowdown has also affected corporate earnings, with many companies reporting lower profits or losses in the past year. China's property sector as well, which accounts for about a quarter of the economy, is facing a severe crisis, as many developers struggle to repay their debts and avoid default. The crisis has triggered a domino effect, as other developers face similar liquidity problems, and home buyers demand refunds or compensation. Regulatory environment of China has become more uncertain and unpredictable, as the government has launched a series of crackdowns on various sectors, such as technology, education, gaming, entertainment, and finance. This has created a level of confusion and fear among investors and businesses, as the rules and penalties can often be unclear or unexpected. As many factors have contributed to the seemingly declining performance of China's stock markets in comparison to the past. A major Chinese mainland stock or share index fell nearly 11%, and major Hong index fell nearly 14% in 2023, making it one of the worst performing major Asian stock market. So, China is considering a rescue package backed by offshore money to stave off a slump in its struggling stock markets. Chinese authorities are aiming to get about 2 trillion yuan, primarily through offshore accounts of Chinese state-owned companies, as part of a stabilization fund to buy shares onshore through the Hong Kong exchange link. The plan, if implemented, would be one of the largest interventions in China's stock markets in recent history. It would also signal a shift in China's policy stance, from relying on market forces to using state power to support the markets. The plan could provide a short-term boost to China's stock markets, as the influx of money would create buying pressure and lift the prices of undervalued or oversold stocks. It could also improve market sentiment and confidence, as it would show the government's commitment and willingness to support the markets. It could also attract more domestic and foreign investors to the markets, as they would see the opportunity to benefit from the rally or the bargain prices. It could also have some long-term benefits for China's stock markets, such as improving the quality and efficiency of the markets, enhancing the role of the markets in allocating resources and financing the economy, and increasing the integration and openness of the markets. However, the plan could also have some risks and challenges for China's stock markets, such as giving distorted market signals, and could possibly increase financial vulnerabilities. The plan could also face some operational and regulatory hurdles, such as coordinating the offshore and onshore entities. The plan may trigger adverse reactions from other countries, such as the US, which may view the plan as a form of market manipulation or unfair competition. Let me know your thoughts, and be sure to take a moment to subscribe.